I'm now focusing on balance sheets. I'm going to assume volatility. I'm going to assume, worst case, we have a long trade war. Maybe it goes for right to the election. Who knows? At points like this, maybe moving up the quality is a little better in terms of risk taking. So I'm just looking at large entities that generate a lot of cash, that are reducing their debt, and also are returning capital to shareholders through either dividends or stock repurchases. And when you screen the market for that, you find some really high quality companies across multiple sectors, like a J&J, really boring stuff, Melissa. But when you look at how these have performed recently, you're happy to own them because the market tends to trade back to quality when there's times of concern.
What's interesting is that throughout this year, investors have consistently underpriced the risk around trade and around potential escalation. So one of the things we pointed out about 2 weeks ago was that actually emerging market equity volatility had fallen to a one-year low. And that was despite, emerging market credit spreads rising, that was despite stronger dollar, that was despite obviously ongoing trade negotiations. So this tells you investors have consistently been, I think, too optimistic around this issue.
Is that an opportunity to hedge positions in emerging markets, which has been a very popular trade?
Yes, right. So we actually came out and recommended investors buy downside protection in emerging markets. That trade worked out well. But I think, one of the things that's notable with this correction compared to Q4, I get a lot of questions around that, is that this time we are seeing more hedging activity, right? So Q4, investors sold stock, moved to cash, didn't want to have anything to do with the market. This time around, hedge fund investors holding onto stock, but layering into hedges. So that's, I think, what's interesting about this market.
We are highlighting the downside, and we've thought about tariffs as mostly being focused on corporate margins, almost ignoring for now the impact on aggregate demand, but really focusing on price increases and what that could do. So we've recently been talking about 26.50 as a possible floor here if we see EPS come down, if we see multiples take a turn lower. So perhaps rationally, the market's gone halfway to that already. We're not changing our target yet, but even before the trade talks flared up, we had limited upside to the year. We thought a lot of the big catalysts had come through the system already, and that's probably where we remain for now.
It's an impact to GDP. The inflation aspect has to be transitory because ultimately you can't really pass on that much of the cost. But a lot of this is somewhat reflected in equity prices. We had about a 4% pullback this month, and remember that lower interest rates support multiples, so the valuation case isn't a bad one. If you're looking for places where maybe some pain has already been felt, one of the interesting places is mid-caps. Margins already started to decline in Q4 in mid-caps, and after a 3-decade run of good outperformance, they've underperformed in 2017 and 2018 and already going into this year. So there are pockets of the market where there's opportunity.
We are positioned fairly moderately leaning into risk at the moment, and I think we're cognizant of some of the long-term risks. What is the end game here, the trade issue? But I think it's also important to be a little bit more pragmatic about it. We're thinking about trade-induced volatility as potentially introducing some buying opportunities in equities, and I think there are a few reasons. One is that despite being bad news, last week was not the worst news that it could have been. There's still a path back to the negotiating table that you can see. Second is that the economic feedback of the tariffs themselves. There's a case to be made that it's much worse to introduce tariffs on new products than to increase the rate on existing tariffed items. And so going from 10 to 25% is not good, but incrementally it's not as bad because a lot of the weaker links in that supply chain were already picked off at the end of last year. And then finally, in case we haven't noticed, there is an endogenous kind of very tricky feedback between the economy, markets, and the negotiations themselves. If things get bad enough in terms of the market reaction and the economy, then I think that's what facilitates them returning to the negotiating table. So there's a circuit breaker there, even though bad news is bad news.
I think the major change going on in the market mindset right now is the journey versus destination. For quite a while, we all expected the tariff tit for tat to be part of a journey that still leads to free but fairer trade. Now, there's growing concern that these higher tariffs may be part of the destination, and that's a completely different calculus for the market.